and welcome. My name's Gillian Tett. I'm the chair of the US Editorial Board of the Financial Times, and I am delighted to welcome you to a treat, which is the chance to have a sit-down conversation, or rather a across the Atlantic Zoom conversation with Jeff Staley, the head of Barclays Bank. And I can't think of a better person to be opening this year's British American Business Conference, because he's someone who really epitomizes the transatlantic, not so much divide as connections. He's American. He worked for years with JP Morgan in parts of Latin America, as well as in America itself. He's now, of course, running Barclays, that great big British banking group in London. So he's looking at the story of financial services, markets, and business in general from both sides of the Atlantic. So Jess, great to have you here today. Thanks for joining us. And I should start by asking you, where are you actually talking from?
Well, I really appreciate having this conversation with you, Gillian, and give you a shout out for what you've done for so many years with the Financial Times. I'm actually talking from my London office in Canary Wharf. We do have, from our call centers to our branches, we have a lot of people, even during lockdown, that have to come to work, and so I find myself here a couple days a week, and so we're in London, and it's towards the evening time right now.
Right. Well, it's great to talk to you. Now, like most of my American friends over in London, I'm sure you've been watching the US election with bated breath. Still watching events with pretty bated breath. I suspect will be for some time. But I'm curious, how do you see the new administration potentially impacting the US-UK trading, commercial, financial relationship? Are you expecting much of a shift? Do you think there should be a shift going forward?
I think there's quite a deep recognition in both the US and the United Kingdom of how important this relationship is. The United States is and companies that are domiciled in the United States are the largest group of investors in the United Kingdom. And in fact, institutions in the United Kingdom represent the largest country investing in the United States. So that in itself, I think, underscores the unique relationship between the two countries. They share a common language. They share historically a real embracing of globalization. I've been party to a number of conversations around the negotiation of the free trade agreement between the British government and the U.S. government, which obviously will continue with the new president elect. So I think between the US and the UK, I think we will continue to move towards a free trade agreement, which recognizes the mutual gain that both countries get, and not a big change in policy with a change in the administration, with two caveats. One, what is a big change in the United Kingdom is leaving the European Union at the end of this year. And I think Brexit puts a particular importance on the trade agreement that the UK negotiates with the US, because it is now just the UK alone as opposed to the European Union. I think that changes the dynamics, but in many ways makes the speed with which a free trade agreement is negotiated and the nature of it all that more important, I think, for the United Kingdom. And the other one is, I think, the understanding that the new administration will do things like rejoin the Paris Accord. I think will be more embracing of the World Trade Organization, and seek, if you will, sort of a return to a more central role as the world manages itself as a global group. So I think that will also impact the nature of the trade agreements between the U.S. And the U.K. But we're quite hopeful, particularly in the financial sector. The free flow of capital between the United States and Europe is and the UK is so critical to how the world finances itself. We're pretty optimistic that this will all work out.
Right. I mean, in terms of Brexit itself, are you expecting that to create a shock for the City of London when it finally happens? Because of course, it's been such a long teaser game about when it will happen for such a long time. Do you think it's all been priced into the markets? Are everyone's systems up and running and ready to survive without a shock?
Yeah, so when the referendum passed over a couple of years ago, we brought the executive committee of Barclays together on that Sunday. And we made a couple of assumptions. And one of them was Brexit on one level is obviously a massive political issue. And given the politics of it, we felt then that that we would never really know the ultimate settlement between the UK and Europe until we got to the final end of the grace period. In fact, what we underestimated is they kept moving the goalposts a couple of times after that. But the political back and forth, I think, was something that we all should have expected, because the politicians really don't have the urgency to find that compromise until the last moment. And that indeed, I think, is what is going to happen. The other thing, however, is there is a trade deal between the UK and the European Union, in as much as the UK was part of the European Union. So it's not like we've got to renegotiate every aspect of commerce and goods and services between the UK and Europe. What really is being negotiated are amendments at the edge for political reasons. But again, the exchange of goods and services between Europe and the UK is so dramatic. Trying to reset to zero would be massively disruptive on both sides. And as such, I think London will continue in the very important role it plays in finance, in global finance. I think it was very interesting for us when the European Union announced their 100 billion euro social bond initiative. In the first tranche of that, a couple of weeks ago, they raised 17 billion euros and had some 200 billion euros of demand, actually. There were 3 European banks who led that transaction. 1 Asian bank led that transaction, and 1 British bank, Barclays. And I think to a certain extent, they were looking for Barclays to connect with the investors here in London on behalf of Europe, but also in New York on behalf of Europe. I think that was a very, very telling example where you've got the European Union raising 100 billion euros for social programs, principally to help the unemployed in the states that make up the European Union, tapping the global capital markets for one of the largest capital raises ever by a sovereign. And Barclays was deeply honored to be selected as one of the 5 lead managers in the opening tranche.
Right.
And then London just has a lot of assets for it. It's got a great legal structure. It's got a great educational base. So we're quite confident that London will maintain a very important financial center. There will be activities that will move to the continent, to Europe. I think we'd all like to see a growth in the capital markets in Europe, whether it's Frankfurt or Paris or Madrid or Milan or Dublin, where our European bank is headquartered. But I think the UK will continue to have a very, very significant role.
So just to clarify, do you see any shock happening in the first week of January? I mean, is it all priced in and all prepared for?
I think it's pretty heavily priced in. Yeah, I don't. I mean, it's not as if it's going to surprise anybody. So yeah, I think and I think right now it's being overwhelmed by the economic consequences of COVID-19, the
Right.
virus.
Well, I often think if there's ever a good time to have an event happen that could reduce demand, you might as well do it at a time when demand is reduced already. And so you almost don't notice. But, and just to quickly, before we move on, can I quickly come back to the US-UK trade
Sure.
issue for a moment? Is there anything that you think should be on the inbox of whoever the next USTR head is, the next Commerce Secretary under, let's presume, a Biden administration, in terms of financial services? Is there anything you'd like to get fixed that you think needs to be fixed that's not being talked about right now?
So I think what's very important, and the UK just announced the outline of a new trade agreement with Japan. And one of the very important things in that agreement for, I think, London, for Barclays, for the financial system, is basically a recognition from both parties of the value of what they call a regulatory cooperation. I think post the financial and economic crisis of 2008 and 2009, a lot was done around the world by the regulators to work collectively and cooperatively to have a broadly unified approach to how you regulate the financial markets, and particularly how you regulate the banks. That's been repeated in the trade discussions with Japan. I think that is very important to put on the table with the U.S. as a trade agreement gets negotiated between the U.S. and the UK. The free flow of capital, it's simply too important to have a regulatory framework which gives preference to one location or another. That would be a spiral down, which I think would hurt all of us. And so I think that regulatory cooperation is very important. I know it's very much on the list by the Bank of England and by Her Majesty's Treasury here. 35% of our revenues of Barclays comes from our business in the United States. And having a regulatory framework which is balanced between the US and UK, I think is very important. And it goes back to what I said earlier. I think now that the UK will be a sort of its standalone country, that regulatory cooperation or collaboration becomes even more important. So I hope that will be high on the list of the new Biden administration.
Right, interesting. Well, certainly as the dust settles, I think there'll be people around him pushing for that in New York. But can I turn to an issue which hasn't got a lot of attention on the regulatory front in public yet, wasn't mentioned at all in the election campaign, or as I can see in the Brexit debates, which is a regulatory framework around AI and the dash towards digitization? Because the dramas around Ant Financial have been presented as a story about Jack Ma and the Chinese regulators. To my mind, actually, it's missing a trick, because the real story is the degree to which Ant Financial has dashed ahead of many other banks in the world, in fact, all other banks in the world, about trying to embrace not just artificial intelligence, but deep learning inside its financial services. To what degree is a bank like Barclays trying to do that? To what degree do you think you can do that kind of strategy inside London or New York? And what about the regulatory regime? Because this has barely begun to be addressed yet by regulators in either the US or the UK.
As always, Gillian, you bring up a massive question. Banks, and Barclays for sure is becoming a technology company, and finance is indeed being digitized. And to a certain extent, we are becoming entities that effectively manage data. How you manage data, where you store the data, who has access to the data, is all critical for a bank like Barclays, who's got a presence around the world. And the regulatory framework around that is enormous. And you're right, I think we're in the very beginning stages of that. take it down to the micro level of Barclays. We have built 3 major technology centers around the world. One in Whippany, New Jersey, one in Pune, India, and one in Glasgow. We have other facilities, particularly here in the UK, in places like Radbrook and whatnot. But having the free flow of information and data between those 3 centers, and we run this bank 24/7. We actually, in those 3 centers, have war rooms that sort of look like a NASA center, where we track, all the data, all the payments, all the transactions, all of the social media, everything that goes in and out or touches this bank. We pass, we have in these 3 centers, and we pass it 24 hours a day around the world. And who ends up managing most effectively that technology and that data for the benefit of their consumers and their clients and their employees? Those will be the institutions that really thrive in this modern environment right now. A little bit like finance, I do think it's going to be very hard for the governments to corral what in many ways is already out of the fences. And then there is so much overlap. We partner with fintech companies. We have a very important relationship with Amazon. We use their cloud services. They basically introduced Barclays to the cloud services. We could not be running with 55,000 people working remotely from home if we didn't have the flexibility that Amazon's been providing us. And now we just announced today, actually, a partnership between Amazon and Barclays in Germany to merge our point of sale financing business with their, with the pipes they have for e-commerce in Germany. So all these connection points, and everyone is viewing this this data marketplace and this technology marketplace as a global one, and it's going to be a real challenge, I think, for the regulators to get their hands around it.
So, I mean, do you think something like an Amazon plus Barclays could give Ant Financial a run for its money in terms of the tech capabilities? And does it worry you that the implications of so much of the deep learning technology, which is expanding at an exponential pace right now, essentially put it beyond the comprehension of regulators, whether they're in London, Washington, or New York?
I think everyone who's involved in business and commerce or finance has got to be both tremendously energized by what technology may hold for all of us and terrified at the same time. When I think about Barclays' future and what technology can do, like the agreement we just announced with Amazon, I think that's one of the most powerful things that's happened in the 5 years that I've been here. But for sure, there's a risk to our business model, and we still have some 750 branches in the UK. What's the economic viability of that network, and how will that play out with technology? Simple things like if you go back a year and a half ago, it would take a small company 6 weeks to be onboarded as a client of Barclays. You had fintech companies coming in and doing that in 4 minutes. And it took us a year and a half, and now we're down to roughly 4 minutes. So, but that's the sort of competitive pressure that the evolution of technology is going to bring. And I've said this a couple of times, when I started banking some 40 years ago, the basic science that you needed as a banker was accounting. You needed to understand assets and liabilities and revenue recognition. I think I was reasonably good at that. One of the things that always sort of scares me about this job is on one level, the science that you need today to run a bank is how to read and write code. And I don't do that. So I think there's a challenge for managements as well as regulators, as large companies, small companies. One other angle to all this is, as a bank, we are heavily regulated. I don't think an Amazon wants to be regulated the way Barclays is. And I think one of the things that we're seeing here in the UK, at least, is fintech companies which are basically acting as vehicles to hold client wealth or client money. My own view will probably see a new level of regulation. E-wallets. People believe in an e-wallet, and that if the fintech company says I've got X money in my e-wallet, it's there. And I think there may be the need for greater oversight to make sure that that's true. So the whole regulatory framework around finance, around banking, I think will be evolving. And one of the things that I think we're reasonably good at now at Barclays is dealing with a lot of regulators. So, so that may become a competitive advantage.
Well, that's one way to put it. Although I must say, so much of the regulatory debate, insofar as it surfaced on the US campaign trail, insofar as it's been tossed around in relation to Brexit, in my view, has missed it completely because it's so backward looking and focused on mortgages, which is yesterday's story, not on this AI stuff, which is going to be absolutely crucial going forward.
Yeah, but I also think that we do need to give credit where credit is due, and the economic shock of what we saw at the end of March, early April, and into May was truly terrifying. I mean, a third of all spend in the UK goes through our payment pipes, and our numbers were down close to 50% in April. And I think you have to give credit to the regulators and all the work that was done over the last decade. I think the banking industry has a very good chance to be part of the recovery and a real contributor as a partner to that recovery, as opposed to 12 years ago being a catalyst for the economic crisis then. And then I think you also, and we can talk about this, have to acknowledge the just extraordinary and unprecedented response to COVID-19 in both fiscal policy and monetary policy, and the speed and the depth of what people like the Bank of England and the Federal Reserve, et cetera, have done in the face of this pandemic. I think has given all of us hope and the ability to hopefully recover faster than many of us thought possible just a few months ago.
Just before I ask you another question, I want to touch on the moment, which is green finance. But before we talk about that, where are we with the recovery process at the moment? And what do you make of the fact that the hopes about a vaccine coming down the tracks soon have caused bond yields to swing in a way that suggests that investors are getting a bit nervous about future inflation? Is that a sensible thing to be worrying about right now?
So let's separate it into two questions. One, what do we see in terms of economic activity in the next couple of quarters? I think you had a medical crisis lead to an economic shock unprecedented, perhaps in the last 100 years, met by an unprecedented response in fiscal and monetary policy. One of the reasons why that is working is because up until now, governments and many corporations have been borrowing at zero interest rates, if not negative interest rates or negative real interest rates. So the financing of this massive response by governments and businesses, the burden of that to a certain extent is not that great because people are borrowing for free. When they flooded the markets with liquidity, in the last 6 months, we've been a lead manager in over $1 trillion of corporate debt and sovereign debt issued around the world. I mean, that's just a staggering number, and that's allowed companies like Delta Airlines and British Telecom to keep people employed, to keep functioning, et cetera. And imagine if we didn't have a different interest rate environment right now, trying to deal with all this level of debt. And I do think that the infusion of liquidity, the government support in terms of consumers and small businesses, et cetera, I think it's having a significant impact. And I think what's very important is recently, both in Europe and the UK and the US, but governments are saying we're going to extend the financial support for those that are more vulnerable. So in the United Kingdom, the whole program around financing small businesses, they have extended now to next year. The furlough program has been extended now. And so I think the notion that the governments were going to run out of road and sort of stop the support for the economy before the COVID-19 pandemic got addressed, I think it's pretty clear now that the governments are going to stay engaged and believe that they have access to funding to stay engaged. So I think the economic recovery will be much stronger than, again, we would have thought 4 or 5 months ago. And so we are more encouraged with the economic outlook. And quite frankly, I think that's clearly reflected in the equity markets. To the inflation side, and now let me give another sort of twist on it. One of the things that I've been wrestling with the last 5 years is, where is inflation? And interest rates at this low level, how sustainable is it? Because I think, at least how I was sort of educated, if you have fiscal deficits this high, you have monetary policy as aggressive as this, the bond market would react, and you would have a prediction of pretty high inflation. Now, we've had a little bit of movement in the last couple of weeks, but it's still very, very benign. And so I asked myself, what's going on that has made it so benign for so long? And the truth is, there hasn't been wage pressure. And generally, it's wage pressure that the market sees and then anticipates that translating into inflation, and they move the bond market accordingly. We're not seeing that wage pressure. And so then you ask yourself, why aren't you seeing the wage pressure? And then that comes back to me to perhaps the biggest challenge we face, which is, I think we're not seeing the wage pressure in part because of technology. The economic growth is being built on the back of intellectual capital, not labor. And what that is doing is it's widening the divide of income inequality.
Right.
And so to a certain extent, when we look at it, we worry less about inflation and the ability to finance these government deficits and more about social unrest on the back of income inequality, and how do we all deal with that as societies and as communities. Because you look again back in the UK, the economic response to COVID-19, there are clearly many winners and there are tragically many losers. And that divide is growing at a scary rate. And so the government and social response to income equality, I think, is a much bigger issue than will we have to deal with inflation down the road.
Right. So the chance of a financial market crash is less than a chance of a political explosion and social explosion going forward.
That's
yeah,
right.
That's a good point. We're practically out of time. Can I ask one last quick question, since we are the British American Business Forum, which is this. Lots of excitement from Rishi Sunak about the idea of London being the green finance capital of the world going forward. Do you think that's likely?
I think it's a very good possibility of that. Yep. And we are very supportive of what the Chancellor is doing. We're very supportive of the meeting in Glasgow soon around climate change. We are a very big supporter of the Paris Accords. Barclays was one of the first banks to declare that our ambition is to be fully compliant with the Paris Accords and to be net zero by 2050. We are very active, in underwriting green bonds, whether it's the European Union, whether it's companies around the world. We just did one of the largest green financings in Japan for one of the largest solar farm companies there. So yeah, I think the ESG issue is real. It's real with our shareholders. It's real with our investors. So I think we need to understand that transition is important. But for sure, you've got the commitment of the British government. You feel it, and I think the UK very much wants to be a leader as we deal with climate change.
Well, it's going to be interesting to see what happens because, of course, this is one area where the US has lagged significantly under the administration of Donald Trump. And although it'll be interesting to see whether, the administration of Biden or President-elect Biden can change that, there's a lot of work to be done in terms of the financial regulations around ESG in the US. But sadly, very sadly, we are out of time. But thank you very much indeed, Jess, for all your thoughtful comments. Very best of luck getting the workforce in Barclays in the US and the UK back to work. Any plans to come to New York anytime soon?
As soon as I can get out of lockdown and quarantine. But right now we're on lockdown until December 3rd. So not for a while. But my two daughters are there, so my wife and I's hearts are in the U.S. and in New York. But for now we're all buttoned down in London.
Well, like many of us watching, we have a split world at the moment on Zoom, and we're trying to keep an eye on both sides of the Atlantic. So thank you. Best of luck to all of you watching, and I hope you enjoy the rest of the program.